Great, thanks, Peter. And I also want to echo my thanks to the tax analysts and the American Bar Foundation for the invitation to speak here today. And I was asked to kind of focus my remarks a little bit more on the process side. It's a little bit like eating spinach, but it really does shape the content and the ultimate outcome of tax reform. And I think it's really a metaphor for some of the bigger issues that both Peter and Daniel have touched on already in terms of how we line up with the rest of the world and why we do things differently or why we want to do things the same or any of that. And I thought I'd first kind of maybe begin the reaction phase of the panel and talk a little bit about the VAT, kind of building off of some of the earlier comments. And just from my own personal experience, I remember joining the Ways and Means Committee staff in 2011, and my own thought about the VAT was, yeah, it's probably a good idea. It's probably something we should do, but it's a matter of political will or the lack thereof and the unwillingness to kind of go in that direction, either because it's a French tax or for some other reason. But at the committee, over the 4 years of Chairman Camp's chairmanship, we held 30 some odd tax reform hearings, 36, I think. And we had any number of academics or economists come up and testify and talk about how great a VAT is and how much we need it, all this stuff. And it really dawned on me why it's not a good idea. And it has nothing to do with the substance of a VAT or all of the theoretical arguments about it. It has more to do with the realities of what a VAT would look like once our Congress got done with it. The VAT that I heard described in those hearings would never be the VAT that would be signed into law by the President of the United States. Arguably, it'd probably end up being about as bad as our current system when they got done with it. So my feelings about a VAT are probably on a more practical level and what that would end up looking like after our political process got done with it. And I think that feeds into what I was here to kind of talk about, which is just our process. And one of the things that I always kind of go back to is when we do talk about how we're different than other countries and we're an outlier, we have a high corporate rate. We have to remember we don't have a parliamentary system. We have a system of I'm not sure really what we've ever called it, checks and balances. I call it controlled chaos. And whatever the current environment is, we have to remember the basic system has been the same for over 200 years. And so we're not in a position to say, yeah, we're going to reduce our corporate rate in 2020 by 2 points. I mean, we just don't do that here. We can't. Our system doesn't allow that. And so we kind of have to work with the system we have. And our system is unique, just like our tax system is unique, and it creates unique tax legislation. And I think when you look at the blueprint, and I'll say one of the biggest problems with the blueprint is they never came up with a very good acronym for it, the DBCFT or whatever it is.
The BAT.
It rolls right off the tongue.
Yes.
When you compare that to, let's say, the Camp draft, for example, or take any other kind of piece of normal tax legislation, it really is a good way to learn how our system processes tax legislation. The blueprint is a very commendable idea, a very commendable document. Even though, as Daniel pointed out, I mean, out of the box, they made concessions to a pure consumption tax that sort of taints it a little bit from what you might want to do in a pure level. But the blueprint is a proposal to transform our tax system, and all of the provisions in the blueprint, even though there's not a lot of detail, but all the provisions are very interrelated. It's not a piece of legislation where you can kind of say, okay, let's just pull this one thing out, or let's tweak this thing, or do that, because you do that, and the whole thing kind of falls apart. I mean, it doesn't make sense if you change to a significant degree, or if you pull out, let's say, the BAT or anything like that. That is not what tax legislation normally looks like. Tax legislation normally looks like a series of provisions in a tax bill. For the most part, can be interchanged and pulled out and put in and moved around, because that's what the members of Congress like to do. They like to try to play around with things, and the blueprint doesn't really allow you to do that. So just as a process matter, I think the challenge that Speaker Ryan and Chairman Brady have had is that it operates at a more take it or leave it level than what we normally expect to see in tax legislation. It's a very difficult proposal for the system to digest. And in the closest analogy I can think of is really the ACA. The ACA in some ways was kind of the same thing. We're going to transform our healthcare system, 1/6 of the economy, into something completely different. And if you kind of go back and look at some of the original proposals, I mean, you kind of think about the blueprint, but even there, we ended up with something that was largely a function of compromise and things that were kind of cobbled together. So rather than repealing the exclusion for employer-provided healthcare, we ended up with a Cadillac tax, which is kind of the worst way to do a repeal of the exclusion, just from an administrative standpoint. So that's what our system does. Okay, so that's how we do tax legislation. And so as you're seeing the debate unfold over the blueprint and some of the challenges the speaker and the chairman are having, I think bigger picture, rightly or wrongly, you're seeing the members, particularly on the Senate side, start to gravitate more towards what they are more familiar with, the kind of discussion and negotiation that they are more familiar with doing, which is let's put things together and run the math and have JCT put a table together and see where we end up, and and then just kind of start adjusting. There's not a lot of adjustment you can do to the blueprint. And so, big picture process, I think that's kind of what we're seeing unfold right now. Talking more technically about the process, another thing we're very unique about is our budget process. Even in the U.S., this is not something we've always had. So and everything kind of flows from politics, right? So we had an election. The Republicans won the election, but they didn't win it enough. They only have 52 seats in the Senate. And so for the last couple decades, the party that's in the majority in all what I call all three branches, because I consider the Senate and the House to be separate branches. When they have all three branches, there's a lot of enthusiasm to doing things, but unless you have 60 votes in the Senate, you have to resort to other tactics. And so we have this thing called budget reconciliation, which is kind of an arcane budget rule. It's been around for a while. And you really have to think back to what it was originally designed to do. It was originally designed to make it easier for Congress to reduce the deficit. That's all it was. And so it operated that way for many years. It allowed you to have a deficit reduction bill go through the Senate without being torn apart and never getting off the Senate floor. And then along comes 2001 when the decision was made to maybe repurpose the reconciliation rules. I was on the Joint Committee at the time. And there was a lot of bloodletting on the Senate side over the decision to use the budget reconciliation process for not only tax legislation, but actually tax cuts, kind of counterintuitive, right? Thought it was supposed to be deficit reduction, and we're actually using it for tax cuts. And so that was kind of really the first time we saw this in action. And ever since then, that's kind of been the purpose of the budget reconciliation rules, even more so than what it was originally designed to do. So we had an 01 bill in reconciliation, we had an 03 bill in reconciliation, ACA, which is basically a tax bill wrapped in a healthcare bill, done in reconciliation, or at least the tax parts were done in reconciliation. And I'm sure I'm forgetting other reconciliation tax bills in the 2000s. So that's what we use it for now. But because of our repurposing of it, we have to deal with some kind of funky rules in reconciliation. It's a little bit of Faustian bargain, right? It's primarily designed to allow legislation to move through the Senate. Reconciliation doesn't really matter on the House side because the House already operates on majority rule. It's really designed to grease the skids on the Senate side. So you don't need 60 votes. The bill can't be filibustered. That's one side of the bargain. The other side of the bargain, though, is there's all kinds of conditions that go with the process, the reconciliation process, again, because it was designed to reduce the deficit. And the big one when you're using it for tax is, as Peter alluded to, you cannot increase the deficit beyond whatever the budget window is. And as Peter also alluded to, there's nothing written in stone as to what the budget window is. We've used 10 years now for the last couple decades, I guess. It used to be 5 years. There's nothing that says it couldn't be 20, 30 years. There's been talk about that on the Hill, along the lines of, okay, fine, we'll do a big tax cut, we'll sunset it. 10 years kind of stinks, but maybe 20, 30 is pretty good. I mean, 20, 30 years of a tax rate is basically permanent in our world. So there's been a lot of talk about that. But again, as I like to say in tax reform, every solution brings a new problem. The problem with using 20 or 30 years is you have to use it for the entire budget. And what happens to the entire budget 20 or 30 years from now, we don't even want to see, because that's when the entitlement horribles start creeping in. The fiscal imbalances beyond the next 10 years, and maybe even within the next years, get severe. And so in order to do a 20, 30-year budget window for tax reform to have a longer sunset, those issues would also have to be addressed in that kind of a budget. And that means either cutting entitlements or increasing revenues. I mean, we're talking about whether it be revenue neutral or tax cut. That would require potentially significant revenue increase. I don't know if it's a new tax system or what, but that's the limitation on that particular tactic. And so and what's kind of unique about the budget reconciliation process when you talk about tax reform is, unlike other instances we've had the last couple decades, tax reform is not inherently a partisan idea. I think probably not a member of Congress, Republican or Democrat, would disagree with the notion that we need to change our tax system. Nobody likes our current tax system, right? So there, right out of the gate, it's different than what we've seen before. I mean, the 01 tax cuts were largely a Republican exercise. 03 Republican exercise. ACA Democratic exercise. There's nothing that says tax reform has to be R or D. In fact, it may be that the biggest benefit of reconciliation on the Senate floor for Majority Leader McConnell is that he only needs 50 votes, no matter where he gets them from. You know, there are scenarios where maybe he loses Republicans and gets a couple Democrats to get to 50. 50 votes is 50 votes, and it's not 60. So trying to use the reconciliation process for tax reform, even compared to other tax bills where it's basically a straightforward rate reduction exercise, is something that I think they're learning as they go in terms of what the dynamics are, what the trade-offs are. I tend to discount, discussions on the Hill and things, I tend to discount the idea that we're just going to default to a big tax cut. I think the idea that that's the default is probably a misimpression in terms of that's kind of the path of least resistance. It's not the path of least resistance. There are people who get very squeamish about, on both sides, about revenue reductions in the order of hundreds of billions of dollars. As we know, if they probably have to use reconciliation, we're going to have to sunset it. There was a letter from the Joint Committee on Taxation released recently that said, unlike the individual side, where you can actually have an individual tax rate that exists for 10 years and then sunsets, you can't do that necessarily on the corporate side, because there's tails to rate reduction on the corporate side. And so even a 2-3 year corporate rate cut is going to have out-year implications when you think of less carry forwards being utilized in the window, or the behavior on repatriation. And so doing a big tax cut, I think, is actually, you could almost argue it could be harder both politically and substantively than trying to do revenue neutral and making the policy permanent. But we'll see how it plays out. I mean, we've got a long way to go, and I'm not saying that won't happen. I just don't think of it as the default option necessarily. I think the important thing about reconciliation, though, to note, because I do think that we could see it in play here, is you have to remember when we talk about these rules like revenue neutral, not increasing the deficit beyond 10 years or whatever the window is, that's not applied to the bill as a whole. That is applied title by title to the bill. So you could have a tax bill that sunsets in part and is permanent in part in the reconciliation process. And so imagine a scenario where we do a tax reform bill where what I call the architectural parts of the bill, where we're dealing with the structure of the code, whether it's going to a territorial system or expensing or things, interest deductibility, are all offset and made permanent, because what we definitely don't want to do is have our system structurally change 10 years from now. We don't want to adopt a territorial system only to have it go back to a worldwide system 10 years from now. That's not as big a deal, I would argue, on the rate side. We've done that before on the individual side. I think people, you know, generally the outcome may have been unsatisfying to both sides, but we had 10 years of lower individual tax rates. And conceivably, you could do the same thing on the corporate side without doing a lot of damage to business planning and things like that. So just remember that even as complicated as the rules are, the way they're applied are fairly complicated. And you know, as my Senate friends always tell me, every time a House guy talks about the reconciliation rules, an angel loses a wing. So they know the process far better than I do, and so, you know, it'll be interesting to kind of see how that plays out. So I'm going to stop feeding you the spinach now so Lee can start reacting to all this.